Now let's take a look at the big picture with Wayne Wilbanks, Chief Investment Officer at Wilbanks Smith Thomas Asset Management. He oversees about $1.8 billion in assets. And Wayne, I thought it's interesting reading through your notes here. You think that the earthquake in Japan is going to have not a significant effect globally, but that the crisis in Japan obviously couldn't come at a worse time for them fiscally.
Right. I mean, I think you all have done a good job of coverage on the Japanese debt issues that they have. This lost decade that they've just gone through. So, from their perspective right now, where they're spending almost half their budget on debt service, this couldn't come at a worse time for them.
I want to get a trader's perspective from Doug Prskalo of Blue Capital Group. He's at the Chicago Board Options Exchange. Doug, yep, a nice little rally here, but again, the volume not so strong here. Does that kind of reduce the significance of it in your view?
I think that's a very good point. I would say so. With everything going on overseas, Japan, Libya, until all that stuff gets sorted out, you're going to see spikes like this. But as we saw during the week last week, which is a really hectic week down here, there's, overnight futures could move 20, 25 handles like they were moving last week. So, yeah, the traders see it. We're up 18 on the S&Ps. The 1,300 mark in the S&P is a, big number for us down here. But I don't know. My sense is not everybody's buying this rally today because tomorrow could bring something totally brand new.
But let me ask you quickly, Doug, about Wayne's point, which is that while obviously the earthquake and the ongoing crisis there is horrendous for everybody in Japan, it seems like people here in the U.S., or certainly at least the markets, are done with that.
Yeah, I would think so. I mean, as soon as, they supposedly are getting water to the plant, I'm not trying to get too technical. That's what people down here need to know. The big word nuclear, and I hate to throw that out there, but that's what's scaring the market. And anything to do with nuclear, the fallout, that scares the market. Right now it seems under control, but as I said, tomorrow could be a whole new thing. So go ahead.
No, you're so right, Doug. I mean, each day brings some new news, certainly out of Japan. Speaking of Japan, we actually caught up with international investor Mark Mobius. He's pretty confident about the country. He spoke to us this morning from Cape Town. Listen up, everyone.
The way the Japanese market has fallen, if it was an emerging market, I'll be in there buying because it's a great opportunity. I think they are definitely going to recover. They will come back very strong.
Wayne, let me ask you, actually, Julie, first of all, before I get to you, Wayne, because I do want to get your thoughts on that. Julie, we've also got PIMCO, though, also kind of looking at some of the emerging markets here right now.
That's right. Looking at the emerging markets, looking at debt, PIMCO being PIMCO, looking at the debt in particular, and saying that it's more attractive, perhaps, in these emerging markets. You've got rising wages in many cases. You've got public and private sector debt that's under control versus some of the developed economies. And you also have growth that is at a quicker clip, remains at a quicker clip. They're looking at emerging markets like the so-called BRICS. They're also talking about Mexico. And overall, they say we could see GDP growth adjusted for inflation of 5.5% to 8.5%, whereas in the so-called developed economies, you would see growth of only 1% to 3.5%. So for that reason, they're looking more to emerging markets. As we know, PIMCO has recently told us that they've been pulling back on U.S. debt. So presumably, this is one of the things that could perhaps step into the gap and start to replace that. So, Wayne, I would ask you, I guess, I mean, whether you're looking at Japan or the emerging markets outside of the U.S., what seems attractive to you?
Well, I mean, there's this big theme between creditor nations and debtor nations. So the creditor nations are these emerging countries, and that's a secular play. So we've got an above-average weighting in emerging markets, and would use this backup we had so far this year to be adding to that emerging market position. Flip side, we think you've got a summer coming up here with these Southern Europe and the Ireland situation. It really kind of got unnoticed over the last 2 or 3 weeks, but there's some real issues coming up with Greece over the next 2 years, et cetera. So keep an eye on that.
So, Wayne, if there are a lot of issues, and there are, as I think, Doug pointed out, you kind of don't know what the next day is going to bring. Why not just take everything off the table? We've had a nice run for some time here and just kind of ride it out at this point.
Well, because the market is going to put up $92 in earnings this year for the S&P 500. I mean, the corporate profit in the United States picture is extremely bullish. So you could make a case on how the S&P 500 trades at $13.75 if you put a 14.5 multiple on it. So there's upside in the market, but individual investors just need to weigh every 6 months. You're going to get these huge shocks to the system, and they just got to be ready to accept that in their portfolios.
Hey, Wayne, it's Dominic here. Speaking of those huge shocks that you're talking about, do you get the feeling amongst your clients, investors out there, that they're really, I mean, there is fear out there, but are they scared? Have they even remembered what happened in 2007, 2008? Is there any risk aversion out there at all, or are all these dips basically to be bought?
Well, we think there's a new risk aversion among the typical American investor, at least the ones we see, and they're not coming back the way they were in equities for the foreseeable future. I mean, they're beginning to look at their retirement plans and these other accounts a little bit more like an insurance company. They have a liability, which is the income they need, and they're going to match it up. They will not tolerate the kind of volatility that they've seen over the last 10 years. So don't get tricked into thinking they're all rushing back into this equity market, because we don't think they are.
Yeah, hang on a second, because I want to, Dom brings up what happened in 2007, 2008. I saw a great story on the terminal today. We've been talking about it here, that the U.S. Treasury Department is going to start unloading its mortgage debt. And then, of course, we got some negative numbers out again for actual home sales. And Adam, you got a little bit for us here on what looks like still a long road ahead for housing.
Oh, yeah, bottom line, a very long road ahead, and not improving. If you look at the existing home sales, that's the number that we got this morning. Pretty ugly looking chart. Look at that, a series of lower highs. In other words, you've had a dip, but each time when it bounced off the dip, it came back less strong. And nobody likes to see that, certainly no one on the long side of housing. And you look at the performance of some of the housing stocks today, Beazer, Hovnanian, and Pulte. Okay, they're all single-digit stocks, but look at that. They're up just pennies. So, okay, in percentage terms, 2.5%. But again, it's just pennies. So, Wayne, the question is, for viewers who are out there trying to put some money to work, and they look at these little stocks, they say, oh, $3, wow, I can buy a lot of that. Is that a sucker's bet? Do you just let it go and not even bother? Is it too long a road?
That would be our recommendation. I mean, they really need to be looking at the sectors they're in. So, I mean, large U.S. high-quality multinational companies, the Microsofts, the Pepsis, the Intels, the Ciscos, that's where they need to put their focus, because the downside risk in those companies right now is limited. And the upside, you don't need a lot to go right for those stocks to go up. So we'd be very careful with some of those more speculative names.
What does this say then, Wayne, about your confidence in the actual U.S. economy? I mean, you can put money in big internationally exposed blue chips, but if you're concerned about the housing market back here, you can't have a lot of faith in the U.S. economic growth picture.
Well, we think we have a lot of stuff that the emerging markets and the international markets need right now. So our export economy is going to be picking up steam, and that'll be great for these multinationals. However, we're looking at the risk associated with that, and we want to be in these companies that are going to absorb the situations like we went through in Northern Africa or Japan or potentially Southern Europe that'll be coming up. But we will tell you this: the second half of this year, when we have to balance the budget, things are going to slow down. There's no question about that.
It does all sound pretty worrisome. Doug, let's bring you back into this conversation. As you said, you just don't know what the next day is going to bring. But if I look at the rest of the months for this year, we have so much to deal with, whether it's the Middle East, Japan dealing with, obviously, its situation, our own federal deficit problems and getting our states in order and our federal government in order, the sovereign debt over in Europe. I mean, to me, it's going to be a pretty rough market here, or it could be.
I agree. There's a lot of questions out there, and we get through one crisis and we move on to the next. But the whole overriding thing that I see is our housing market here, and it's sometimes these overseas things and these other government problems and the debt crisis in Europe. We forget about what we have right here. And in all honesty, this rally we had today, I'm very surprised with the housing numbers we had this morning. And a lot of people they're just putting the housing numbers aside thinking it's going to get better. But the question is, what happens if it doesn't? I don't really see it improving.
What's kind of the tone on the floor there? Because I think about, Wayne mentioned it. We had some guests, Matt and I, last week who talked about valuations in the market. They look really attractive here. I mean, which side of the brain is kind of in control here? Is it kind of the logical, like, yeah, there's some great value out there? Or is it, who knows what the heck's going to happen tomorrow? What's the tone there on the floor?
I would say both sides of the brain are working right now. That's the best way I could put it. I know it's simplistic, but the big moves we had last week, I think, did remind people. It was a good point brought up earlier of 2007 and 2008. I mean, we were having the S&Ps up 20, down 20 overnight, and that's a significant move. So okay. I would think today that's why you see low volume today.
Guys, we got to run. Thank you so much, Doug Prskalo out there in Chicago, and Wayne Wilbanks joining us as well.